Taxes are nearly everyone's single biggest expense over the course of their lifetime, and entering retirement, this is no different. If you've watched any of my videos before, you know that a big way that we add value to our clients here at Spark Wealth Advisors is through tax planning, which is strategically reducing your tax bill over the course of your life. And while I don't file or prepare taxes for clients, I do review them all for accuracy and sometimes find mistakes that can save clients thousands of dollars. So whether you file your own taxes or you use a tax preparer, you should have a copy of your last year's tax return. In this video, we'll discuss 5 key areas that you should review for accuracy as a retiree. And these 5 things are part of a longer list of 20 plus in a guide that'll include a link below that you can download for free. Hey everybody, my name is Jake Skellhorn. I'm a certified financial planner and co-founder of Spark Wealth Advisors, where we give you the confidence and clarity that you deserve with your money. So the first issue to cover is regarding withholding. As we all know, taxes are withheld on income we receive throughout the year. This is really for anyone, whether they're working or retired. But when you're retired, if you're taking withdrawals from IRAs or receive a pension, that is considered taxable income, and there's a withholding usually associated with it. Well, when you file your taxes, you either owe a little bit more if you didn't withhold enough, or you get a refund if you withheld too much. When you owe taxes, again, that of course means you didn't withhold enough throughout the year. If you withhold too little, you could pay an underpayment penalty, which you want to avoid at all costs. A quick way to see if you owed a penalty last year is to review your Form 1040, line number 38, and it will say a dollar amount of the penalty. If there's 0, that's of course a good thing. But there's a couple ways to avoid paying a penalty going forward if you did pay one last year, known as the Safe Harbor. So the Safe Harbor basically says that you can pay 100% of last year's tax liability, no matter what you owe this year, and you won't pay a penalty. So you can pay exactly what you paid last year, even if your income is much higher. Now, ultimately, if you owe more taxes, you'll still have to pay that when you file the following year, but you won't pay an underpayment penalty. The other way to meet the safe harbor is if you pay at least 90% of this year's tax liability. So if you make $100,000 and your total tax liability for the year is $15,000, if you pay at least 90% of that, or $13,500 by the time you file taxes, you won't owe any penalties. Now, if your adjusted gross income is over $150,000, you would have to pay 110% of last year's tax liability to meet the safe harbor requirement. And by the way, it's the lower of the two. So again, you can pay 100% or 110% of last year's tax liability, or 90% of this year's tax liability, whichever one is lower, to meet the safe harbor requirement for not paying any penalties. The second issue I want you to review on your tax return is regarding capital gains and losses. So as far as investment accounts go, this will apply to your taxable brokerage accounts, whether they're individual, joint, or trust titled. Capital gains and losses do not apply to retirement accounts like IRAs, Roth IRAs, 401ks, things like that. But if you sold an investment for more than it was worth or less than it was worth throughout the year, then you will have a capital gain or a capital loss. Those do offset, so you want to make sure everything is reported properly, especially from the statements that you receive from your financial institution that holds your investment accounts. But it would also apply to selling things like rental properties or any other assets that you sold throughout the year. If you have capital losses that exceed the capital gains that you had for the year, you can deduct up to $3,000 of those losses from your ordinary income from ordinary income taxes. But if you have more than $3,000, the rest of it carries over for future years indefinitely. So you want to make sure that that carry forward loss is reported on your Schedule D as well. A mistake that I've seen before is an incorrect reporting of cost basis on what's called a 1099-B, and that's the tax document that would be provided to you from your institution that has your investment accounts. So cost basis is what you paid for the investment before you sold it. I have seen it where the institution fails to report the cost basis properly, and when there's no cost basis provided, the default is 0. So when you sell that asset, it's going to look like you basically didn't pay anything for it, so you'll pay capital gains on the full amount. So for example, if you bought an investment for $20,000, sold it for $30,000, then you would really only need to pay capital gains on $10,000. But if your institution fails to report your cost basis and it puts in a 0 there, then you're going to end up paying capital gains on $30,000 instead. So again, review your cost basis information on all of your 1099-B documents from any investment account institutions that you have. The third issue to consider is regarding qualified charitable distributions from IRAs. If you're over age 70 and a half, you're able to make what's called a QCD, or again, qualified charitable distribution. That's where you take money from your pre-tax IRA and send it straight to a charity as a donation, and that is not taxed as income to yourself. Since you're not receiving that money, it's going straight to charity. you don't have to pay any taxes on that. So if you're not already doing this and you're making a withdrawal from your IRA first, definitely look into doing that going forward. But make sure that your QCDs are reported properly on your 1040. On line 4B, it should show the taxable amount of any IRA withdrawals, so any money that you did pay to yourself for your living expenses or whatever it might be. Your QCD amounts for the year should not be included in the amount on line 4B, again on Form 1040. In 2024, you can donate up to $105,000 per year directly from your IRA to a charity as a QCD. The fourth issue to review on your tax return is regarding rental properties. If you own rental property, review Schedule E as part of your tax return to review all the expenses that you deducted on the property's rental income. Mortgage interest, property taxes, insurance, maintenance, lots of different things are deductible from rental income before you pay taxes on the rental income. Always review this for accuracy to make sure that you're deducting everything you can. This is always a good time as well to review the actual profitability of your rental property. I have talked to clients before who think they're making a lot more money each month on rent than they really are, especially after the expenses associated with the property. So always reevaluate your options to see if that's worth keeping. I did make a video where I went through a case study with a client and helped her determine whether or not she should keep or sell the property. I'll include a link to that video at the end of this one. By the way, if you haven't already, do me a favor and subscribe to the channel here, like this video, and leave a comment if you have any questions. Share it with a friend if you think they could find it helpful. And the fifth issue I want you to review on your tax return that could potentially have the biggest tax consequences if it's reported incorrectly is to make sure that if you processed a rollover last year, in other words, moved money from a 401k through your job to an IRA or something similar, make sure that that was not considered taxable income. Sometimes people process rollovers incorrectly, or sometimes institutions incorrectly report rollovers as taxable withdrawals. So when you're moving a large nest egg from a 401k, this could potentially have a 5 to 6 figure tax bill if done incorrectly. So this would also be on Form 1040, either line 4A or 5A. It'll show the gross amount of your rollover, but it should not show in the B boxes associated with those same lines, which is the taxable amount of the rollover. So, and if you rolled over $200,000, you would want that to be included in line 4A or 5A, but not 4B or 5B. If your rollover amount was included in that taxable box, you would first want to reach out to your tax advisor to see what they recommend. If you file your own taxes, you may want to start by reaching out to the custodian to see if they incorrectly coded the 1099-R form, which is what's used to report a rollover. And from there, they may need to reissue a corrected one, and you may have to file an amended tax return to get those taxes back. So like I mentioned, this is just 5 of a list of 20 plus issues that you should review on your tax return to make sure no mistakes were made, whether you do your own taxes or hire a tax preparer each year. There's a link in the description below where you can download it for free. Let me know if you have any questions in the comments below. And as I promised, here's a link to that video regarding the rental property analysis for a client that we recently did. Thanks for watching, and we'll see you in the next video.